Joining us on the CNBC Newsline is Jeff Gundlach, CEO and Chief Investment Officer at DoubleLine Capital. Jeff, great to have you with us.
Hi, Melissa. Good to be here.
You thought Remain was the base case scenario for a long, long time. You actually bought European equities about a week ago. You sold into Brexit. What made you sell? What's your next move?
Well, I did think that it was going to be very close, and I did agree with the market consensus that developed in the recent days that Remain was going to win. But maybe the rain, who knows? Maybe history's been determined by a rainstorm. Who knows? But I did buy European stocks a week ago Wednesday and sold them yesterday simply because they were up so much. And when you have a bird in hand factor of a high single-digit, nearly 10% profit, and you've got a massive uncertain event, it's good risk management to take that profit. So I sure was glad I did when I got the news last night. So right now, we're in a world that is characterized clearly by lack of cooperation. I mean, that's sort of the definition of what happened with the vote. And sometimes people say bull markets are defined by 20% up and bear markets by 20% down. I reject that kind of simplistic metric. My way of thinking about things is bull markets are about cooperation. I mean, that's what makes things, societies thrive, and that's what creates economic growth, is people cooperating. If people don't want to cooperate, then there is much slower growth. And I mean, if you want to be really hyperbolic about it, if we don't cooperate at all, we're all out there in the woods with a spear chasing a squirrel. So I think we're in an anti-cooperation world right now, and so I've been in a capital preservation mode stylistically all year. So
basically you think that we're effectively in a bear market?
Well, let's take a look at some numbers. Germany is down 23% from its high. France is down 22. Spain is down 34. Italy is down 35. Japan's down 28, China's down 45, and the Morgan Stanley All-World Index is down 14. So I've been saying for weeks and months, really, that when I hear people say this is the bull market that people love to hate, I say, what bull market are they talking about? I mean, the S&P 500 has been dead money for 18 months, and now it's right back to the bottom of the 3-month range. In one day, it went from the top of the 3-month range to the bottom. So, yeah, I think this is a capital preservation market, and I've been talking about a global growth scare coming this summer and a downward pricing in assets. I do think that this vote sort of corroborates the anti-establishment kind of sentiment that's out there. It's probably incrementally positive for Donald Trump's kind of wind in the sails. So I think this is a capital preservation market. I do observe that even bonds haven't rallied very much. I mean, this week, the 30-year Treasury bond is up in yield by a basis point, kind of no big deal. I mean, a lot of volatility about remain or leave, but not a big rally in bonds either. It's interesting how bonds have been, over the past 2 years or so, having huge moves kind of overnight that take you down 20, 30 basis points, and then they don't hold those lows. So the 10-year Treasury at 158 is low, but we were down at 157 last week. So I really think that it's a good thing that the Fed is no longer talking about raising interest rates. But I think that negative interest rates are really the problem. We go through these stock markets that I showed you were down so much. These are all kind of the manipulated markets, the manipulated Chinese market, the manipulated interest rate markets, and negative interest rates are not good.
Jeff, I just want, before we leave the Brexit vote alone and everybody moves on to the other good market information that you're giving there, you stood out for a long time in saying that you actually thought that Britain would vote to remain because it was the logical, I think, and I'm paraphrasing what you said, it was the logical thing to do, and when people got into the ballot box or got into the ballot booth, effectively they would make the correct decision in their own self-economic interests. Clearly they haven't done that, and I just want to pick up which you're inferring the ramifications of that people now, when they vote, may not vote in what classically would be their economic interest, that actually the emotions are running away with that. In the case of the UK, arguably putting immigration and their feelings about immigration above all else, as may have been the case here according to the UK Independence Party.
Yeah,
where does that logically take us? Where does that take us moving forward?
Well, I think that you're hitting on a good point there. I'm quite certain that the immigration thing is what's at the root of all of this. And people, they want change. In Britain, they were never really in the euro anyway. I mean, they never adopted the euro currency. They were always sort of halfway there. And so it's when you think about it now, it's sort of logical that they're the first one to give it up. But I think that people are, what I think is happening is there is a bear market. I've been saying this now for a number of months. There's a bear market in confidence in market manipulators, policymakers, central bankers, politicians broadly. And I think there's a bear market in confidence in planning. And that's why I've been long gold and gold miners all year as my largest long position in my macro fund. I think that gold is a play on a bear market in confidence. And you know, obviously it's surged a lot now. It's back above 1,300. But I wouldn't be surprised to see another up leg in gold. I'm talking about a 1,400 target. And I just think there's a bear market in confidence in politicians and the establishment.
Sure. So in terms of capital preservation, Jeff, going back to that theme, you mentioned your largest position in gold and gold miners. Where else in this market, especially as we are watching the S&P 500 right now hit new session lows, where else in this market can one preserve capital?
Well, there's always cash. There's always really boring, you know, short-term, high-quality bonds. People have been asking me for a few weeks. They say, I know you believe that exit's not going to happen, but if it does, what should you do with your portfolio? And I said, look, I'm managing high-quality bond portfolios largely, and my portfolios are up substantially today. I don't need hedges. I just need to not have positions in these dangerous markets that are subject to these massive volatility moves. And so I think for U.S. investors, it seems sensible to be playing in your home currency and to be playing in very high-quality bonds. And You're not making a lot of money, but bonds have been outperforming stocks by a significant amount for the past couple of years.
On the price, they continue because certainly in Europe, the central banks, you can buy the 10-year German Bund, and you know the central bank's going to be forced to come in of its own planning to buy behind you. You may think there's a deficit in confidence in the central bankers, but let's assume they're going to continue to be as they are at the moment, and their only reaction to slowing economies is more QE and the buying of more assets like treasuries and bonds. Does that mean that you can still make money? Or do you fear that at some point it's going to crash?
I'll leave that to you because I have no interest in playing that kind of greater fool theory. I have no interest in buying negative 10 basis point yielding 10-year bonds. If I'm supposed to be looking at a backstop of a central bank taking those rates even more negative, I just think that that's something that investors are welcome to do, but I'm not going to join them. I have no interest in investing in something that over the fullness of time is a guaranteed loss. So I know that those bonds have done well this year. The best performing bonds for a dollar-based investor this year are Japanese bonds that start out with the lowest yields in the world. But that is a greater fool theory on steroids, and I have no interest in playing that kind of thing, and I'm not going to expose my investors' money to that sort of a scheme.
As for bonds, Jeff, earlier this year in January, I believe you made a prediction that the yield on the 10-year would break record lows, and at that time is 138 or so on the 10-year yield. Where do you think we go from here? I mean, we're pretty damn close to it overnight.
I don't think I said that.
Okay.
I think, frankly, I was looking for a range-bound market, and really, I still believe we're in gradually rising interest rates over a multi-year period in the United States. And because of the action that we've seen over the past really 2 years of these massive flight to quality trades that happened seemingly overnight. I remember one in October of 14 that was really unbelievable, and they don't hold. I mean, the 10-year Treasury bond is at 158 or so, but it was down near 140 last night. It doesn't hold these levels, and it's interesting that it got down close to the all-time low close of July 2012, and once again has kind of resoundingly rejected it by rising 18 basis points off that level. I really don't think interest rates are going to go, thankfully, into the world of Germany, Japan, and these other countries with all their experimentation. So I think bonds in the United States are clearly range-bound. They're anchored in part by the fact that central banks in Europe and Japan have really pegged these negative interest rates, so it's hard for U.S. rates to rise. But let's face it, what exactly is the reason for U.S. rates to rise at this point? You know, the global economy is being downgraded. The Federal Reserve is clearly not raising interest rates anytime soon. The warp function on Bloomberg terminals, which is the probability of a Fed hike, is 0 all the way through November. 0 chance of a Fed rate hike.
Do you think we get a cut?
No, I don't think we get a cut. I don't see why the Fed, who has been itching to so-called normalize, which is jargon for raise interest rates, why they would cut just because of a multi-year separation process that appears to be underway in the UK. There's really no reason for the Fed to cut. I think a cut would be counterproductive at this point. What we've seen is the lower interest rates go, when you go into negative interest rate world, stock markets do not go up. They go down. The European stock markets, they peaked when Europe went negative. That was the peak. They didn't rally after they went negative. They've been falling ever since. Negative interest rates are the definition of deflation. You cannot fight deflation with deflation. One of these days, these central bankers will go one step further to negative interest rates, and it will have the same effect: weaker stock markets, weaker economies, stronger currencies ultimately, and then they're going to realize, like the guest that when I was waiting to come on the show, they're going to go to fiscal stimulus. It's absolutely certain, I think, that we're headed to fiscal stimulus, and that will have an impact. In the short term, it'll appear to work. I mean, part of the GDP equation is the delta in government spending. It will increase short-term economic growth at an incredible detriment of the structural debt-to-GDP ratios, but that's the last thing left to try.
Jeff, I'm not going to ask you where the stock market is going, but you're pretty pragmatic, so I'll try to ask you a pretty pragmatic question. S&P 500 earnings are supposed to be about $120, give or take. Those numbers probably have to come down. With that said,
I'll take the under. Yeah.
I will as well. But what's the right multiple in the environment that you just described so eloquently? What's the right multiple for that S&P?
On trailing earnings, I'd say the right multiple is probably around 12.
12 trailing, which probably gives you maybe a 15 or so forward. Is that fair?
Forward would probably be, I think 15 would be a little full, but yeah, it's in the realm.
So the folks at home can do the math on the back of that. I mean, I think that's what you have to look at when you look in this environment.
Right. I mean, earnings are dropping. What's really amazing is every year for the last 5 or 6 years, going into the new year, there's a prediction of 10 to 12% earnings growth, and it came out at 5 and 5 and 5, and now negative for 2 years in a row. And now the dream is that we're going to have this huge earnings bounce off of a lower base, admittedly. But I mean, I'm from Missouri on that one. I want this thing to prove itself. We've got nominal GDP growing at about 3.2, 3.3% in the United States. But we've got, you know, things like rent, things that people must pay that are rising at faster than that. We've got some wage measures that are being legislated higher, like minimum wages. If nominal GDP is growing slower than wage growth and slower than rent, how can you possibly get a significant increase in earnings? And so I think we need to have a significant, more average sort of a trailing PE. Now, interest rates are very, very low, so of course that supports higher valuations on all assets, but if earnings are dropping, you're facing a very significant headwind.
You know, Jeff, what about people who've just switched on today, may not watch CNBC very often, and they hear what you're saying, which sounds quite scary. They'll hear Alan Greenspan earlier in the day, and he was really scary. He was really downbeat. What do people do with it?
That's right, yeah. But
what do you do with the forum? What do you do?
There was a fantastic newsletter writer who wrote a newsletter for something like 60 years named Richard Russell. It was called Dow Theory Letters, and he wrote a fantastic essay that was called Rich Man, Poor Man. And what his point was that if you have savings, if you have accumulated wealth, you don't always have to try to make the market work for you. You have to wait for bargains. You want to wait for those time periods when, by old school, you actually have a single-digit PE, which hasn't been seen since March of '09 when I did turn bullish on stocks based on the single-digit PE. But we're not coming.
Is that what people should wait for? Is that what you see 3 or 4 years down the line when fiscal QE fails?
I'm not sure if fiscal QE will fail exactly. It'll work for a while, and then it'll ultimately, I think, will lead to an inflationary situation where equities will be a good way to protect yourself from inflation, ultimately from lower levels. But I think you're supposed to wait for bargains. You make 80% of your money 20% of the time. And what's really important in investing is patience. Not always trying to make every single day a profitable day. Sometimes it's okay just to make a few percent in safe investments. These days, if you're making a couple, 3, 4% in safe investments, you're doing much better than what most people are experiencing by trying to time these incredible, volatile, dead money equity markets. The S&P 500 is unchanged in 18 months, and it's had 2 drawdowns along the way that probably frightened people out at the low. So most people have lost money on stocks for the past 18 months, and some of them significant money. It's okay to wait for bargains. In fact, it's prudent. It's risk management. It's what investors need to do.
Okay, so Jeff, we covered a lot of territory in this interview, but I want to sort of bottom line this with you, and that is you see the values in the market being in gold, gold miners, high quality bonds, and perhaps cash?
That's pretty much it. I've been espousing sort of this barbell concept of very safe financial.
This sounds like a bunker fund, Jeff.
No, it's just making money slowly, gradually, and sleeping at night. It's fine. You don't have to be out there making speculative bets on Tesla all the time. It's okay to make money slowly. You know, the markets, they take the stairs up and the elevator down, and it's important not to be in the elevator.
All right, I got to ask you about your ETF, Jeff, the Total Return Tactical ETF. It's about a year and a half in the making now. Well, what have you seen in terms of flows into it, and have you noticed that you're going to reach a pretty important milestone soon, and that is perhaps having more assets under management than the PIMCO Total Return Active ETF?
Oh, yeah. Well, I guess that's true. The Total is a good, low-risk, short-term investment. It's much lower risk than most bond funds, lower interest rate risk, diversified among sectors, spinning off a decent income stream. The flows have been very strong because this is an environment where making money slowly and sleeping at night should be and is attractive to a significant subset of investors, and I'm one of them.
Is this a feather in your cap to exceed on the AUM front versus PIMCO?
Not really. I'm not interested in being the largest fund or the largest investor. All I want is to fight the fight for my investors and to help them survive through this type of environment. And I'm pleased that we've been able to do that, and that's the reason for DoubleLine's success. And we're going to do everything we can to keep that going.
Jeff, thanks so much for phoning in. We appreciate it. It's great to get your insights on a day like today.
Well, happy to do it. Thanks a lot.
Jeff Gundlach of DoubleLine Capital.